I think we're just seeing the end of the seasonal weakness in Bitcoin. And every single time this cycle, starting in January of 23, where I felt like there was a dislocation or discrepancy between where I thought Bitcoin's fundamental value is and where it was trading, like within days or weeks, that gap started to close. So like, I feel like we should be at 130, maybe 140 right now. And so my suspicion is some point in October, those numbers will seem like they're right there again. And Bitcoin, as you know, has a tendency to do that. Looks dead. And then you wake up one day and it's just absolutely ripping. And so I think October, November, December probably be quite good. That doesn't mean, by the way, that the Bitcoin miners that are up 48x are the top performers, right? Like maybe some of that is pulling forward future returns, right? But it is possible that that outperformance actually continues.
Markets have a way of humbling strong opinions. This cycle has been no exception, with Bitcoin miners and related equities moving in directions that caught many off guard. Alfred points out that while Bitcoin itself hasn't really gone anywhere, it's still hovering around 111 and looking weak. The history of these cycles suggests that weakness doesn't last. Every time Bitcoin has looked undervalued against its fundamentals, it has quickly caught up. His view is that by October it wouldn't be surprising to see prices in the 130 to 140 range. Bitcoin often looks dead before it rips higher, but Alfred cautions against assuming miners will continue to outperform just because they've already been on a tear. In fact, some of the recent gains may be pulling forward future returns. That doesn't mean the story is over, but it does mean investors need to think about where the real drivers are coming from. In the case of companies like Iron, the biggest growth has little to do with Bitcoin itself. Their success in AI and high bandwidth compute has reduced their reliance on mining, making them a different kind of bet. The cycle so far shows just how different the paths can be. Iron is up nearly 50% since the late 2022 bottom, while MicroStrategy has exploded more than 20x. Alfred recalls how not long ago the internet consensus was that miners were the dumb trade compared to MicroStrategy. Now the dispersion tells a very different story. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The dispersion is really incredible. I mean, I was doing the math on the cycle returns, and Iron is up 48 or so X, maybe a little less for the full cycle since the bottom in late December. MicroStrategy is only up like a little over 20X now. And it wasn't that long ago that people were screaming on the internet that if you're an idiot if you didn't own MicroStrategy and you own miners instead. And, I tried not to be too harsh on those people at the time, and I'll try to resist the urge to beat on them too much now. But candidly, Scott, there are a lot of people on the internet spouting off about investing that don't really have any experience investing, don't have any experience with governance, don't have any experience sitting on boards, don't have any experience operating companies. And so I warn people all the time, like, you should use Twitter X as a entertainment device and maybe as like a reverse sentiment indicator.
Sentiment gauge. I was going to say, yeah.
You have to be really careful about using it to actually make decisions unless you really understand the mindset and the psychology and the experience level of the people that you're listening to. But anyway, like, long way of saying, at the bottom of the cycle, way back in December of 22, going into Q1 of 23, when nobody knew what Iron was, right? They knew Mara, they knew Riot, they knew Hut 8, right? Maybe. They didn't know Iron, they didn't know Cypher. I called those two companies out specifically as probably the two best operators. And I said, operational excellence this cycle will win out over hype, narratives, branding, marketing, overpriced CEOs, etc. And here we are, and that's exactly what happened. Iron and Cypher are the top two. We'll see where Cypher shakes out today. It's in a little bit of a correction because they're launching an $800 million convertible after their $3 billion Google FluidStack data center deal today. So I think long-term bullish, but short-term it's putting some pressure. But it's an exciting time because if you actually are a stock picker, right, if you actually know how to assess these companies, you're getting paid excess return right now for being able to do that. Like, basically skill is being rewarded, whereas at other parts of the cycle, basically blind luck or FOMOing in or YOLOing in or whatever, right? Just like randomly picking stocks based on your favorite influencer, like that kind of works during these sort of uninterrupted bull markets, but it doesn't work necessarily for the full cycle unless you're ultimately right about the fundamentals. As you just said, though, maybe the most important comment was that Bitcoin still hasn't done anything, right? It's still sitting at 111, like it looks pretty weak. I think we're just seeing the end of the seasonal weakness in Bitcoin. And every single time this cycle, starting in January of 23, where I felt like there was a dislocation or discrepancy between where I thought Bitcoin's fundamental value is and where it was trading, like within days or weeks, that gap started to close. So like, I feel like we should be at 130, maybe 140 right now. And so my suspicion is some point in October, those numbers will seem like they're right there again. And Bitcoin, as you know, has a tendency to do that. Looks dead. And then you wake up one day and it's just absolutely ripping. And so I think October, November, December probably be quite good. That doesn't mean, by the way, that the Bitcoin miners that are up 48x are the top performers, right? Like maybe some of that is pulling forward future returns, right? But it is possible that outperformance actually continues because the catalysts that are driving a stock like Iron right now aren't necessarily Bitcoin related. In fact, it's the opposite. Like the more successful Iron is with AI HPC, the less likely it is to do more Bitcoin mining in the future.
Alfred sees the current environment as more early cycle than late cycle. Rates are easing, the dollar is softening, and long-term yields are starting to come down. Historically, that kind of backdrop supports growth assets rather than signaling an imminent top. For that reason, he doesn't buy into the idea that this cycle must end in 2025 just because past cycles did. In his view, the odds now favor a peak closer to 2026 or even 2027. If Bitcoin finishes 2025 in the 130 to 150K range, Alfred argues that won't mark the end. Instead, it would be a launch pad for higher levels the following year as momentum builds. He points out that cycles don't repeat perfectly, they evolve depending on macro conditions and capital flows. A major variable this time is the AI capex cycle. Every forecast Alfred has seen points to heavy data center and infrastructure spending through 2027 to 28. The analogy he draws is with the dot-com bubble where tech capex peaked just before markets rolled over. Today we're nowhere near that point. Money continues pouring into data centers, energy, Bitcoin, and AI. In his words, this feels more like the third to fifth inning, not the ninth. Let's get back to the interview.
I think we've talked about this a bunch, right? Over the last 2-3 years, I've always tried to sort of probabilistically weight the potential cycle top as time progresses. And at the bottom of the cycle, I was pretty confident that the cycle top would happen in basically the back half of this year. I think what's happened is the institutional factors have totally changed the slope of the curve. And I also think, like in retrospect, when we look back at every previous Bitcoin cycle, the halving may not have really been driving things as much as we thought. It could have been that the Bitcoin cycle was so tightly coupled with the liquidity cycle and with the election cycle and some of these other forces that we managed to convince ourselves that the Bitcoin mining halving like has more impact on the timing of the cycle top than it actually does. And so what I'm seeing when I look at macro right now is it seems like we're more like early cycle on macro, right? Like we're getting an interest rate cutting cycle. The dollar is still weakening. Like bond yields are sort of like, especially in the long end, are starting to come in a little bit, which is nice. Like it feels like it feels like a good time, right? And the market might actually be ahead. And so I worry a little bit about extrapolating the previous cycle and assuming just because it happened on this timeline before, it'll happen again. So I'm now thinking that it's much more likely that if there is a so-called cycle top in Bitcoin at all, that's like clearly recognizable in retrospect, like I'm pretty sure that'll happen in 26 or 27 now. I think the odds of it happening in 2025, given how late in the year we are and how little exuberance there is about Bitcoin, I just don't see it. I think we could run to 150, maybe even 200 by the end of the year. That's possible, but I don't think that would be it. I think if we get to 200 in December, maybe, right? But if we're only at like 130, 140, 150 in December, my suspicion is we're going to go higher in 2026. And the last thing I'll say, Scott, is the A on this particular topic is like the AI CapEx cycle is going to elongate for the next 2-3 years. Like all of the forecasts that I see show no top in AI CapEx spend until 2027 or 28. If you look back to the dot-com bubble, which is sort of like the best large-scale equity version of what's happened in crypto in 2017 and 2021, the CapEx for internet data centers topped out just before the market did. So like you can see very clearly CapEx spiked all the way into 99, 2000, and then it plummeted. And so like just because something happened a certain way before, like it doesn't mean it's going to happen the same way. Bitcoin and AI are very closely linked at the data center level, at the energy level. There's a ton of CapEx still going into both sectors. You just don't see major tops when there's a lot of CapEx investment, when there's a lot of IPOs, when there's a lot of M&A. And so it just feels third to fifth inning to me still, right? There's no signs you typically see of a seventh, eighth, ninth inning. And so I just think it's very unlikely that there's any top this year. I think people need to be patient and wait for actual real euphoria. Yeah, I think Bernstein's at 75 and like Arit was there too. But like the sell side analysts are always 2 or 3 years behind the curve of like really good buy side analysts, right? So like my job is I read their reports just to see what they're thinking, but they're always going to be 2 or 3 years behind, right? And so like it's not really that valuable. I don't really put too much basis on like what those guys are saying. But look, Iron could be, and I said this when Iron was $1 billion company and CoreWeave is an $85 billion company. I said Iron can pass CoreWeave in market cap. And since then, CoreWeave's come down to 40 something and then bounced back to 50, 60 something. Iron's gone from 1 to basically 13 billion, right? Some combination of stock returns and a little bit of dilution in there as well, right? Over time. So it looks a little bit more obvious that that's the case. And the path to doing that is just to keep growing the cloud consistently over time and filling up those data centers with customers. And I think Iron has the skill set and the ability to do that. And I think others will try to follow. As I said, I think Cypher could potentially follow some portion of that strategy. I think CleanSpark potentially could follow some portion of that strategy. I think they're getting serious. They're one of, not the largest Bitcoin miner in any given month, along with Iron and Mara and Kango and a couple of others, right? And like, I think that's going to be the story for the next year or two is like, what percentage of your total capacity do you devote to AI? And then within AI, how much do you do co-location versus how much of it is going to be cloud? And I think Iron right now is the clear like lead horse from a market cap standpoint because they've shown the ability to control the full stack, owning the land, the power, the infrastructure, the data centers, and the chips directly, and then monetizing with an end customer. I think that's the highest revenue. It gives you the most control of the relationship. And so I suspect more people will want to do that too. But they may find that they're a little bit behind now because, Iron had a nice head start.
What stands out in this cycle isn't just Bitcoin's price action, but the divergence in how different parts of the ecosystem are behaving. Some companies tied to mining have morphed into something closer to infrastructure plays riding the wave of AI and high compute demand. Others remain more tightly tethered to Bitcoin itself, moving almost in lockstep with every rally or dip. That kind of dispersion wasn't as visible in earlier runs, and it's a reminder that the landscape is maturing. Investors aren't just choosing between Bitcoin and miners anymore, they're weighing which models are built to endure once the easy gains fade. At the same time, the broader environment, falling rates, a softening dollar, and structural spending on AI makes this cycle look very different from the rigid 4-year template that many assume defines Bitcoin's trajectory. Instead of peaking on a fixed schedule, this phase has the potential to stretch longer, shaped more by capital allocation across technology and energy than by a halving calendar alone. The takeaway is that the story now goes beyond digital currency. It's about how Bitcoin intertwines with the next wave of technological build-out and how companies position themselves in that overlap. That's why timing the top is so much harder this time around. Too many forces are pushing in parallel, from global liquidity shifts to corporate strategies that blend mining with AI. Investors who only look at Bitcoin's chart may miss the real drivers of what's unfolding. This feels less like a closing act and more like the setup for another stage of expansion, where the definition of a Bitcoin play keeps evolving. So the real question becomes, as AI infrastructure, energy demand, and digital assets fuse together, will the winners of this cycle be those holding the coins themselves or those building the scaffolding around them? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.